Welcome to the Banking with Life podcast. This is our Q&A series where I answer your questions regarding the infinite banking concept, becoming your own banker. Let's get started. This gentleman says, "Hi, James. I watched your YouTube video on how you finance your truck, and I have a question. You said that you put $30,000 into your life insurance policy as premium, and I did. And then you took out a loan to pay for the truck. I did, and my wife has not. The truck's paid for, and the loan's repaid, but my wife never missed a loan repayment. I just want you to know that. Okay. And then parentheses, you were going to pay the $30,000 anyway. So why not go through a policy? That's what I said in the video. I was going to purchase a truck anyway. And frankly, I thought I was going to be buying a truck, $18,000, $19,000, $20,000. When I called the individual that I purchased the truck from, who's clients and have become friends and been in the pre-owned automobile business many years, third generation. And, he gave me a rundown. He said, well, you can get he asked, number one, what do you want? Ford, Chevrolet, or Dodge? And I said, yes. What do you want to spend? I don't know, 18, 19. And he just basically told me what year model I could buy at what price range. And the top of that price range was $30,000. So that's where the $30,000 came from. Okay, that amount. Okay. He continues. My question is, since you'll want to pay the $30,000 loan back, quote unquote, don't steal the peas, then didn't you actually just pay $60,000 for your $30,000 truck? Question mark. I'm enjoying learning all about the real infinite banking concept from real NNI sources. Well, I really appreciate the email and the opportunity to answer the question. And I was just speaking with the AV ninjas right before we turned the camera on. I think we have about 5 or 6 modules in the Learning Center and probably, 5 or 6 more on the drawing board. But some of those modules are very old, and this one as well. I think I purchased that truck in 2014. Here it is, 2024. So that's 10 years old. And so we just had a conversation about going back and doing a commentary on some of those modules, which I want to do. But directly to your question, didn't you actually just pay $60,000 for your $30,000 truck? And the answer is emphatically no. I wound up paying $18,000 for the truck. Okay. If you watch through that video, because I did what Parkinson's law that time. I was willing to pay $30,000 for a truck, but I bought a beautiful truck for $18,000. Okay. But no, I did not. Let's say I paid $30,000 for the truck and I didn't, but let's say I did. And now I'm repaying a $30,000 loan. Didn't I pay $60,000 for the truck? No, absolutely not. I got the truck, even if I paid $30,000 for it. I have the truck at $30,000. And now I have a loan repayment, all right, because I borrowed. And then I'm even paying additional interest. My wife paid that loan back at 10%, and the company was charging me 5%. Okay. All right. No, I paid $30,000 for the truck with those numbers. I'm repaying a loan for $30,000. Now let's think this through or consider this. Let's say that you wanted to buy a $30,000 truck, and how are you going to get the $30,000? Are you going to work and save it up over time? Or did you just get a gift, or maybe you already have money, cash all saved up somewhere? You just withdraw it from the bank and go purchase the $30,000 vehicle. The $30,000 is what it cost you for the vehicle. Now, if you have the discipline to replace that money, right, that you withdrew from the savings account, is that paying, and you replace 30 grand. You withdrew 30,000 from the bank. You paid 30,000 for the truck. Now you're just replenishing your savings account for $30,000. Would it mean that you paid $60,000 for the truck? No. Right. Let's say that I want to, let's say I want to go buy a new truck, 140 grand. I don't know what they cost. They're crazy. And I don't drive $140,000 trucks. Okay. I'm just saying, let's say my wife wanted a $100,000 car. She can drive whatever she wants. I don't care. Okay. And I don't have $100,000 right now. I'm either going to go borrow the $100,000 and make loan repayments from a third party lender, or I'm going to save up $100,000 so I can pay cash and avoid paying interest. Cash only, Dave Ramsey, don't finance anything. Okay. Well, as soon as I save up the $100,000 and then I go pay cash for the automobile, how much interest am I ever going to earn on that $100,000 in the future? Zero, because it's not in the bank. So the bank's not paying me interest. I get the benefit of the $100,000, seeing my lovely wife happy driving her $100,000 automobile. All right. And then let me ask you this in addition. Is that the last automobile I'm going to drive? Is that the last automobile she's going to drive? How am I going to pay for the next one? Right? If I withdrew the money, bought the automobile, I'm not going to earn any interest on the checking account on that 100 grand or savings account. And if I'm disciplined and I know I'm going to buy a future car or another car in the future, wouldn't I just save up the money and pay cash? I'm either going to save up the money and pay cash, or I'm going to go to the third party lender. There's an interest equation in both of those examples. If I borrow from the bank, they're going to charge me interest and they're going to control the loan. Right. If I withdraw money from the savings account, I'm not going to earn any interest on that money ever again, but I do get the enjoyment of the automobile. Now, in that particular policy, and I've answered many questions on that, and it's really kind of why I want to go back and go through that module again. I built that policy as a place to put money in the future. I've been asked many times, well, James, why did you have the ability to put $30,000 in there? Because I had a flexible PUA, paid up additions rider, and I had not paid the PUA premium that year or the previous 2 years. That particular company at that time, I had a contractual right to catch that up. That's all I did. So I put the $30,000. All of that's documented in the video. I show you the check numbers. I show you all of that. And I also show you the increase in the death benefit by doing that on my wife's policy that will accrue to our children. So I hope that answers your question. No, I only paid $18,000 for the truck. In your example, I only paid $30,000 for the truck. The other $30,000 in the loan repayment is I'm repaying the loan to a policy. That money will be available for me 30 days after I make a payment. So I think we paid that truck off in 4 years. And now there's that $30,000 plus was available to us at the end of the 4 years. And to be quite honest, we bought we've purchased 2 cars since then. We're going to go purchase another one, right? So it's not like that's the last vehicle I'm ever going to purchase. So I hope that answers your question, and I would encourage you to go back and revisit that, okay? But thanks. It was a beautiful question. I love it. In this question, here's 1, 2, 3. There's 3 questions in this email. And when I answer a question on the email, on a Q&A session, I've already answered these individuals privately, right, through email. So it's not like they're waiting months to get an answer. Okay. I'm starting to think more broadly about how IBC could be used amongst my parents and brother. and a larger family in the future. Do you have any good resources to help structure that system? I'm curious to hear examples of what other people have done. A few more specific things I'm trying to understand are, okay, let me address that. Yes. I spoke specifically about proper expansion with the infinite banking concept, but I would first refer you to Nelson Nash's book, Becoming Your Own Banker, page 71 and 72, and even distribution of age classes. He lays out an example. So there's an example there. This is 2024. The last two larger presentations or presentations to larger audiences were specifically on proper structure and proper expansion. And if you're a client, that's available in the client only section on our website. And so I do have resources. Yes. Okay. And then he goes on. A few more specific things he's trying to understand. Number one, when lending or borrowing from a family member's policy. So when lending or borrowing from a family member's policy, how exactly should you determine the interest rate? Question. If the insurance company is charging you 4 and the car dealership is financing at 6, logic and honest banking would say that you charge your family 6, right? Question mark. I assume you would never charge family members less than what the insurance company is charging for the policy loan. Okay, fair enough. The Nelson used to say, look, they're a captive audience. Why wouldn't you charge them more? And if you're talking about a family, quote unquote, banking system, the more quote unquote interest you pay, if the company's charging you 4 and you're paying 6, that additional, what we're calling interest, is going to be premium to the life insurance company, or you're going to pay down the amortization schedule sooner. Either way, you win. If you're buying additional paid up insurance with that additional 2 points on the interest arbitrage, you're also buying more death benefit. Well, pray tell, who all is the death benefit going to accrue to? The family members and whatever structure that is, father, mother, brother, sister. So there are examples, and Nelson says, if they're a captive audience, why wouldn't you charge them 10? Right. And then let me say, and he said many times, and I repeat it often, and I believe it, the banker can do anything they want. They can do whatever they want. So I think that you're thinking it correctly, that you at least should charge the fair market value. The dealership was at 6, but they are valuing money that didn't even exist. The money on that loan that they're charging you 6% for didn't exist until you signed your name. So they're charging you interest on money that didn't exist, right? They value their capital, and I promise you they're going to earn more than 6, right? So what is the value of your capital? I get it. The contractual loan rate may be a 4 or 5. You said 4, whatever it is, it is. Well, that's the contractual details of your policy. What is your capital worth? What is your capital worth? My capital is worth 10 or more. So I hope that answers your question. That I think that you're thinking right. And then too, let me say on family, and everybody has their own opinion. I don't loan family members money. If I did for some reason, I don't want to charge them interest. I've done both. I prefer to give money to family or friends or whatever, rather not lend them money. If I do lend them money, I'm going to charge at least what the life insurance company charges me. And I have charged family members more than the policy loan. But when I do that, they understand the banking function. They understand the infinite banking concept. They're practicing the infinite banking concept. So if I have a brother who, and I don't, God rest his soul, if he was practicing the infinite banking, I would be inclined to charge him 10 or more. If I have a sister that doesn't practice infinite banking, I would just either give her the money or not charge her interest. That's me. Okay. But I think that you're going in the right direction, sir. Okay. Second, when loaning to family, hopefully trust is enough to ensure the repayment. But I'm curious if you recommend any sort of written agreement. And what about when lending to a friend? I don't lend money generally. I'm just telling you, I'm my own banker. I'm not a lender to friends and family. However, I do loan to entities and different things, and there is always a loan agreement. Absolutely. There's a structure that's written. It's correct. It complies with your state. And if you need help, creating a loan document, then I would encourage you to get that help from an attorney within your state. There are very specific conditions that must exist in a contract. And so, beyond the love of a family, I'm telling you that I don't lend money to friends and family. I'd rather give money to friends and family. If I have a family member that practices the infinite banking concept, they understand why I would charge more, and they're, and it's okay all across the board, then I would charge more than what the policy loan is. I would encourage a document that is complete. Okay. What are you going to do? Loan money to your family, and then they fail to perform, and then you are going to sue them? I don't know. I'm just saying, generally, you can't go anywhere. Go to the pawn shop, go to the bank, go to the credit union, go to your broker. You can't get a real structured loan anywhere without a loan agreement. So I think there is an important place for loan agreements. Okay. Now, if I'm going to charge my friend or my family member interest above the loan interest that a life insurance company is charging me because they're practicing the infinite banking concept, then I'll make a note that we'll make a note. It'll be a formal note that you're borrowing this amount. The monthly payment is this, the interest rate is that, and we're both going to agree to it. Now that's not necessarily formal enough to, which I wouldn't, foreclose or pursue legal action against them. But we have an agreement for us, and that's for us, to remember. Like, well, I've been paying you $150 a month, but I can't remember what month I skipped. Hell, I can't either. But the agreement will help us. Okay. Number 3, do you have any resources for tracking family loans and repayments? I'm sure I could set something up in Excel, but there's a big community behind Banking with Life. So I'd be curious to learn from how others do things. Okay. So I personally, I have a third-party resource that we can go on and create loan examples and loan analysis, but it's a subscription-based type software. And that's just one small function of it. So we use that within our office to help our clients determine, amortization tables. Okay. And I appreciate you asking that question. So I don't really have something. I'm not an Excel ninja, so that source that I use, that we use on a subscription basis, is not available to the general public unless you go and subscribe to it. And I don't know if you can or not. I don't know, but I'm not an Excel ninja. But I appreciate you throwing in. There's a big community behind the Banking with Life. So I'd be curious to learn from others. So if you're a listener and you have a resource to track loans and possibly loan agreements or loan documents, please share with us, and I'll pass it on and share it. So thank you for those questions, and I hope they help. Okay, this I like this. He says, right to the question. Do all policies structured for banking have a limited number of years for large PUA premium payments? And the answer is no. So that's just straight out no. Different companies, different products have different periods in which you can pay structured or unstructured PUA premium payments. And then you get into the big wide world, into the footprint of the infinite banking. You see all kinds of weird things. Oh, I want to pay $1 million in year one and, 25 cents in year two, or not. I'm being facetious. I want to pay $1 million in year one and I don't want to pay more than $20,000 in year two. You see all kinds of weird structures, and it is not infinite banking as Nelson taught. All right. Those are imaginations and machinations of the advisor and the agent out there. My opinion. Can it be? Now, is there an exception? There's an exception to every rule. Let's say I have a $100,000 in cash value or an account value in a UL policy, and I don't like it. I'm ready to move on for whatever reason, and I want to 1035 exchange that. Can you receive a large lump sum, from existing cash values into a new policy? Yes. But also let me say I'm not a proponent of replacement. Generally, right? A very specific, client specific, before a replacement should ever occur, in my opinion. Okay. Thanks for asking the question. Do all policies structured for infinite banking have a limited number of years for large PUA? And it's no. Okay. This question. How quick can I borrow from a new policy? I would like to place $40,000 into the cash value and pull a loan as quickly as possible to pay off debt. Man, there's a bunch of people out in the big wide world that love to talk to you. And let me say that I did reply to this individual. And it sounds like he just listened to TikTok, for the afternoon. I don't know. Let me answer the question. So once a policy's in force, right? Oh, you got to go through underwriting, medical underwriting. It seems laborious. It's not. It seems like it's time consuming. It can be because of medical records, exchanging, between the life insurance company and the third party people that handle it for the medical offices. So let's say it takes 4 to 8 weeks to go through underwriting, and I don't know anything. I don't know this individual's age. I don't know what $40,000 in premium would produce in death benefit. Therefore, I do not know what the underwriting requirements are. Okay. But let's just say it took 6 weeks, right? Right in the middle of 4 and 8 weeks. Let's say it took 6 weeks to go through underwriting. And then I pay a premium. Then there's 30 calendar days before I can access a loan. So that's about how quick you can get it done. And I could really continue on this question, but I won't. I answered the question. And thank you for asking it. Thank you for listening. If you have a question that you would like answered, email me at james@bankingwithlife.com. Thank you for listening. Have a great day, and we'll see you next time.